have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets. Where's the gold?
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, joined by Brian London in New Orleans. And if you want to learn more about mining, precious metals, economic freedom, please do consider subscribing. Today we have David Morgan of the Morgan Report. He's also the author of the Silver Manifesto. So welcome to the show, and tell us, all these gold bugs, what are they missing out on? Why have you made silver your claim to fame or your focus?
Well, Fergus, thanks for inviting me. Brian, always good to see you. I'm going to start with gold. I know you asked why would I make silver my focus, and I will get there. But Brian and I sat next to each other at the Money Show very recently, and a lot of people kind of glum about the gold market. And I explained that from the beginning of the bull market, which is early 2000 to present day, gold had had a compounded annual growth rate, compounded, of 10% per annum. The issue, if you want to call it, is that we had all of it that front loaded. In other words, from 2000 to 2011, you couldn't go wrong buying gold. Yeah, it certainly had an up and down move, especially in 2008 during the financial crisis. Gold sold off like everything else, but was the first to recover. It went from about 1,050 down to 700, a little more than 30% loss, but it doubled from there, seeing the financial crisis for what it was. And since then, we've basically been consolidating in what's called a U pattern. So we've been basically frustrated as gold bulls for the last decade. But accounting for the frustration of 10 years and the euphoria of 11 years and putting it all together to where we are now, we still achieve what gold is supposed to achieve. What's that? Preserve your wealth. So if you look at the compounded annual growth, 10%, versus real numbers from John Williams, Shadowstats.com, who utilizes the CPI metrics from 1980, he's averaged about 9% inflation. So gold has done its job. Furthermore, if you look at it from 2000 to present day, it's outperformed the S&P 500 and it's outperformed the bond market. So anyone that says gold isn't doing their job is obviously not aware of these facts. Now, I have to admit, I'm picking the starting line. But, we're supposed to pick the starting line when you're at a bottom. And no one was jumping up and down more than me, maybe Brian, but just behind me. I was the leader.
I was there.
The time to buy. And so what put me on the silver was, like my friend Franklin Sanders that wrote the Silver Bonanza, who was kind of a gold bug until he was commissioned by James Blanchard to write the Silver Bonanza as a co-author. And once you start looking at the silver market, you discover everything that's good about gold is twice as good about silver. Those aren't his exact words. But I went through the same process. I was pretty much a gold bug, self-taught Austrian economics, self-taught monetary history, and looked at gold being the answer during the inflation of the 70s when I was a very young man. And after I made a lot of money in the futures market in the gold side, I wondered, why in the heck did silver outperform gold so substantially? And why did Hunt focus on silver and not gold? And so I did kind of a similar study to what Franklin accomplished. And again, I came to a similar conclusion that they're both necessary. You should own both. Gold preserves your wealth. Silver can at times make you wealthy because it can outperform gold substantially. And going back just a moment, when I talked about the metrics of gold going up 10% CAGR, silver did about 9%. But during the 2008 financial crisis, gold got cut by 30% and doubled. Silver got cut more than half, but it went up fivefold from that bottom. So if you think we're entering another financial crisis, history doesn't repeat, it rhymes, but I think it's a good time to get in. So that's a long answer. But silver to me has what I call a natural corner. And what does that mean? It means that the trend for industrial usage will take up all the silver at some point. Probably, this is theory, this is projection, this is curve fit, by 2030. So we're only 8 years away from the current trend continuing that more and more silver is needed for obviously photovoltaics, electric vehicles, more electronics, more semiconductors, and on the story goes. So I'm still bullish silver long term.
Fergus, I'd like to add my 2 cents to that. Many moons ago, David called me up and said that he was become kind of a silver bug by reading Silver Bonanza, and he wanted to get into starting a newsletter just on silver. And my first response to him was, basically, are you crazy? And because I had been in it for a while, and it's such a cyclical industry, and we're so frustrated at every turn, but greatly rewarded when things do turn our way. So I said, more power to you. However I can help. He wanted to be able to sell Silver Bonanza to readers, and he did a great job of that for us as well. But he became the silver guru, and it is important because there's a lot of people, a lot of silver bugs out there. And I've shared this before, but when I was a budding young copywriter for Jim Blanchard, he once told me, he said, Brian, you need to know that gold bugs are crazy, but silver bugs are effing nuts. And he didn't use the word effing either. But he was absolutely correct. And he could say that with love in his heart, because he was both. He was the ultimate gold bug, the ultimate silver bug. He started a couple of pure silver mining companies that went on to do fantastic things, revolutionize the industry. And as David mentioned, commissioned Silver Bonanza, which was a breakthrough report on silver. But it is leveraged to gold. And I don't even bring in the whole industrial usage angle for silver. Through the millennia, silver has always been kind of the poor cousin to gold, but it's moved more than gold and is the precious metal that more than any other is available to the masses and used by the masses and used in commerce. And it's going, I believe too, it's going to regain that role, and it is going to outperform gold. It always has. So the burden of proof is on anyone who says silver is not going to perform as it has over the millennia. But when there is monetary concern out there, silver does outperform gold in a bull market. And again, I think it's going to do it one more time, at least.
And David, do you want to touch on one point was just the volatility, why that is the case? Why is silver more volatile than gold?
Fergus, thanks. I will answer. Just a point here to make is the Morgan Report. Silver's my passion, but the Morgan Report covers all the natural resources, and we look hard on the equity side. So if you think the Morgan Report is only silver, think again, it's much more than that. So state your question again, sorry.
No, from your initial
volatility.
You mentioned both volatility and the industrial applications making you bullish.
Yeah. So with a constant offtake of silver of more than 50% of the market from the industrial side, you think that would offer stability, but it doesn't, because silver is such a small market and the emotional state of silver investors varies quite widely. So that causes variability, and any small market can move very quickly up and down. Take a penny stock of your choice and realize that, it might not trade any shares for 3 days in a row. And then somebody finds out about the great story and buys a modest amount in relative terms for any kind of major NYSE stock. But in the penny stock world, might put in $100,000 all at once and move the stock 30, 40, 50%. Silver is similar from that aspect. It's a very small market relative to all the other commodities, save platinum and palladium. So that's the main reason. It's a small market, so it can be levered with the futures market and options market up or down with relative ease compared to other markets due to its size.
What about the industrial uses, though? Because my sense is that would temper this human tribal behavior or herd behavior, right? The actual industrial uses follow just economic demand, not our emotions.
Yeah, it's price inelastic. In fact, most users, industrial users, will pay any price for it. because it costs so little in terms of the output. Let me explain. If you've got a $1,000 refrigerator and you're using $5 worth of silver at $20 the ounce, silver goes to $200, it costs you $50, but you're still selling a $1,000 refrigerator. And that's a good analogy for almost all uses in silver, except for silverware, which is a different classification, or silver jewelry, which is a different classification. But your question is, does that tamper the market? Believe it or not, it does somewhat. But again, all markets move at the margin. So it's the last bid that moves the market. So it's that monetary demand or decreasing demand that moves the market. So once the market's been stable, and you'll see this in the charts, it'll go sideways for a very long time, showing some stability for sometimes months on end. Then all of a sudden there's a big short sale by one of the bullion banks, and the price gets knocked down, over a 3-week period, let's say 30%. And then you'll see the trading funds look at it and their algorithm kicks in and says it's a time to buy, and they'll start buying and drive the price back up. And that game has been going on for almost forever, pretty much most of my career.
Yeah, Fergus, I tend to discount industrial demand. I think that David probably would disagree with me on that, but my view is that if silver was just valued on its industrial demand, it'd probably be under $5 an ounce because of a lot of factors. Not that industrial demand isn't important, particularly in photovoltaics, but higher prices don't really have an effect on production of silver. Lower prices don't really have much of an effect on production of silver because it's so much of a byproduct of other production. It's really monetary demand that's the big thing for silver, and I think overwhelms all of the other factors out there. When people get concerned about the purchasing power of their currencies, they buy gold and they buy silver. And for all of the reasons that David just mentioned, silver moves more. So you can get natural leverage on the gold price through silver. And it's almost a force of nature, a law of nature, because it's happened so reliably over so many thousands of years. Not that there's been a free market in the metals for that, thousands of years. There's really only been markets, tradable markets as an investment class in gold and silver since 1971. But gold and silver have existed as money for millennia, and silver has always been for the same effect. It has been the leveraged, the accessible form of monetary metal.
Yeah, and I'd like to just add on, Fergus. No, I agree. It's really monetary demand, pure and simple. Yes, the industrial side's important and it's growing and it's a major trend and on everything. I won't take back what I said. But again, it's the last bid. And the last bid that's going to make silver irresistible is the destruction of fiat worldwide. And when people run to gold, it is going to be noticed even by the major financial talking heads. And that will mean that small market that's so volatile named silver will catch a lot of bids because gold is going to be priced out of their wherewithal to buy it. And that's what happened in 1980. You watch, when again, that was the question I asked. Well, why did silver outperform gold so substantially? Silver in 1979 was $6 at the beginning of January, and it was over 50 in the middle of January a year later. 800% gain in 1 year. Are you kidding me? It sounds like the Bitcoin of the day. Whereas gold was 300 an ounce in December of 1979, and 1 month later, it was at 850. So certainly they both performed well, but why did silver just kick gold's butt, relatively speaking, on percentage terms? We've already discussed that. But just for the record, myself, and I'll speak for Franklin Sanders, have always said it's monetary demand that's going to move this market. Longer term, it could be industrial demand, but I'm not counting on that. What I'm counting on is helping as many people that I can get the word to preserve wealth using precious metals and doing it in the right way in the right amount. You don't have to put your life savings into gold and silver. In fact, that's really ill-advised, but not having any is also very ill-advised.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
This is the Inventa Mining Update. I've got Cherie Leeden of Gold Bull Resources. That's just goldbull.ca. The ticker on this is GBRC, or over-the-counter GBRCF. There's a lot going on with her company. They are primarily in Nevada. She's an Australian, bringing her expertise from there. Now, I know you're changing tack a little bit with the organization. You've divested some properties and you're proceeding ahead, let's say, with less exploration, more actual bringing mining to fruition. So do you want to clarify what that means?
Yeah, sure. So we did divest our non-core Bulgarian assets last week. We've now are a major shareholder of Leeden Resources, ASX-listed company, and there we've got further exposure by those assets, which had just been sitting in the company dormant when we took over Gold Bull Resources. So that's a value add, circa at the current value, $350,000 worth of shares in Leeden. And we're very actively drilling right now. We have a drill rig that's currently putting holes in the ground at Sandman in Nevada. We're 3/4 of the way through that program, and we're very much looking forward to the assay results that are going to be stemming in and coming through the next couple of months. That program was designed at adding some easy ounces, and also at exploring for some new targets. So we're very much, eagerly awaiting those assay results to see if we hit our new targets and how many ounces we added. And then in addition, we're now starting to contemplate a scoping study that looks at essentially the economic viability of our existing resource. We already have 500,000 ounces at Sandman, and I'm pretty confident that that's grown since that last resource estimate was put out there. And given that we're in Nevada, we're in a mining-friendly jurisdiction, it doesn't take too much to wrap around some scoping study numbers to really determine what a feasibility study is going to look like. So we have a couple of different scenarios that we intend to investigate at Sandman.
Yeah, and do you want to give us a little bit of a sense for the timeline? So in the next few months, you'll be getting more drill results. And let's say, do you have any idea when that feasibility study might come in?
Well, we're actively still drilling now, so we can't really complete any studies until we receive all the assay results for this current drill program. We've got about another 1 month of the current drill program, and then say another 2 months for assay results. But in the meantime, we're looking at a scoping study that investigates two mining options. The first is a heap leach scenario where we look at mining the oxidized gold all above the water table and essentially have a central heap leach facility with our 4 resources feeding into that. And the second scenario that we'll investigate is mining the high-grade, essentially outcropping gold from the surface, selectively mining the high-grade portions and toll treating that at another facility. So essentially very low capital costs in that scenario. So I've got a couple of engineers taking a look at both options, and then from their feedback, then we can select which one we really focus on to commence a feasibility study, and ideally Q3.
Do you want to talk a bit about why you favor this more Australian approach of getting started on the mining earlier rather than waiting, as maybe North Americans are accustomed to?
Yeah, the current market for the junior space isn't great. And in my opinion, it's easier to raise development capital than it is to raise exploration capital. And Sandman requires more drilling to get a bigger and bigger resource. Essentially, the more we drill, the more ounces we're going to define. These big epithermal systems, such as Sandman, it's a pretty clear correlation between the number of meters or drill holes and the number of ounces. So there comes a point where you have to decide how many ounces is enough to push the go button on a feasibility study and ultimately make a decision on production. And in Australia, the Australian model tends to be start small and grow and essentially generate cash flow from small scale operating mines and reinvest that cash flow into both mine expansion and into exploration. And it's a model that we've done in the past, and it's a model that I like because it preserves our shareholders, including myself, against dilution. And I think in the current market, being cash flow positive is really going to be critical and key over the coming years. And I'm very bullish on the gold price. With inflation going up, it doesn't really make sense that gold is going down. So I'm predicting that's going to be a short-term blip.
Yeah, I'm right with you on that. Of course, I think it's crazy that during this period of such high inflation, we have seen a depressed junior mining sector. It doesn't make a lot of sense, and particularly as cryptocurrencies have floundered so badly. I mean, obviously, the natural alternative is to go back to traditional hard money or physical metal. So we will pick up this story, and I guess in a couple months' time. Cherie, I've been missing chatting with you, so people go to goldbull.ca for more details. Was it GBRC? Let me get the ticker here. GBRC is the ticker. GBRCF on the over-the-counter. Otherwise, thanks for your time, Cherie. I look forward to next time.
Thank you very much.
David, you are the expert on the history of silver and price relationships, gold to silver ratio, and all of that. I was just wondering, when I look at where gold is going in this next bull market, in this next monetary crisis that we're already enmeshed in, I believe, and typically gold has gone up 6 to 8 times from its low in a cycle to its high in the cycle. From like $103 in 1976 to $850 in January of 1980. And if you look at the low this cycle for gold as, say, $1,040 back around 2015, then what we're looking at then would be something on the order of $7,000, $8,000, $9,000 for gold at the end of this cycle, however long it lasts. What do you think the upside is for silver? If I'm not mistaken, I think that $50 price in 1980 is about, isn't it like $250 in current dollars or something along those lines? Or?
Well, it's $150 if you use the metrics of the government's CPI.
Right. Yeah.
If you use John Williams, it's over 600. So, what metric do you want to use? Let's be conservative and use the U.S. government. So it's at least $150 an ounce. So back to your question or what you outlined, if you look at Elliott Wave, and I'm not a big Elliott Wave guy, but it seems to prove out, at least in the long term, the bigger picture. So if you look at the crisis of 2008, silver decreased 50%. It went from $9 to roughly 50. So 5 nines is 45. So we'll call it 500%. The next leg up, there's 3 legs up and 2 legs down in Elliott parlance and the theory of Elliott Wave. So we had an up, we had it down, we had an up, we had it down, and now we're ready to have the next move up. The last leg up, the third leg up, is the big one. It's the biggest as far as price appreciation, but usually it's not very long in duration. So that's where I came up with what Jeff Christian said at one of the early, I forget if it was a one-on-one meeting or one of the conferences, that 90% of the move comes in the last 10% of the time. And you can prove that is what happened in 1980, as I just outlined. Silver went from, $6 to $50 in a year's time. And that was 7% of the total move of silver in time duration, yet it was over about 92% of the total move. So coming back to Elliott, if we went up 5-fold, the next leg up usually is twice as good as the previous move up. Rule of thumb, nothing in stone. So if it was up 500%, it'd say be up 10-fold the next time. Well, if you take the bottom of the bottom, which was 2020 March when the COVID hit and hit all the financial markets, silver actually traded, Brian helped me out, I think it hit like 11 or something in the paper market. You couldn't buy it for that, any dealer in the country. But so a 10 bagger from there would be 110. I'd be more inclined to use something close to 15 times 10 would be like the 150. That would be just par with where it should be. And markets usually go from undervalued to fair value to overvalued. Silver has a propensity to get overvalued relative to everything, including gold, in a bull market. So I think that's rather conservative as far as where we go in silver. If I had to stab at it and be conservative on the gold side and use the 9, be under 10,000, which is Jim Rickard's number. I think he's recently upped it, but I'm not sure. And we got a ratio of, say, let's say 50 to 1. In other words, not the 84 to 1 that we're at right now. $10,000 gold, you divide it by 100, which would be $100 gold, and double it, so it'd be $200 silver. So that's probably in the range. I'd say 150 to 200. And I know those sound outrageous, and I know I've been saying it for a long time, and I know there's people that have given up, and I know all that. What I also know is there is an infinite demand for money, an infinite demand for money. When money fails, what we perceive as money, when a fiat failure hits the consciousness of the public, there's an infinite demand to move into something real. And there's nothing more real in the monetary sphere than gold, the monetary hitching post of the universe. And silver is a close second. So I am not trying to paint an inaccurate picture here. I'm trying to prepare the minds, because chance favors the prepared mind. And you better start preparing your mind for what's ahead, people, because we have problems, big ones. And if you want to preserve yourself coming through the other side, you better get ready, because we have got trying times ahead, biblical in a sense.
Yeah, and you talk about that potential for silver, and one of the things I tell people is, okay, we've got these macro factors coming up that argue for much higher precious metals prices. You can invest in gold, you can invest in silver, get leverage to gold, and then you can invest in silver miners and get leverage on silver and leverage on gold, and then you can invest in silver juniors to get an even further step of leverage. And of course, these are all investing on the macro trend. There's also the usage of silver and gold as insurance for your wealth, which is absolutely necessary. But there are a lot of ways to play it. And, it doesn't take people long to get involved in precious metals and exploring the reasons for higher gold prices before they kind of gravitate towards silver and discovering what that presents. And there's so much more to it and so much more potential.
Does the lower value by weight or density make ownership of silver different? I mean, it just seems like the logistics would be more difficult.
Somewhat. Looking for one of my bars here, and I don't have it in front of me. Normally I do, but I like to
That
do
amazes me, David. I would think you would have a 10-ounce silver bar at your hand.
Well, I've got a bunch of coins, and
Or
it's funny. I took
paperweights of self-defense.
Here. Anyway, just imagine I'm holding a kilo bar of silver.
Sure.
All right. A kilo bar of silver is almost identical in size to an iPhone.
Okay.
So most people would consider an iPhone to be a high cost per unit volume. In other words, there's very few things that are that small that cost $1,000. But a kilo of silver is 32 roughly ounces times 700 right now. Plus the premiums is close to $1,000. So no one will consider it to be too bulky if you're talking in terms of cell phones. But if you're talking in terms of gold, it is. Why? Because the ratio is 84 to 1. And as you obviously know, silver is less dense than gold, which means it has a smaller volume, slightly, to silver. So silver isn't really all that bulky. I mean, most people in America have a hard time with 4,000 ounces, or excuse me, $4,000, which would be roughly 4 kilos. So I don't think, 4 of those is going to burden anybody with a place to find to store it. But when you get into bigger numbers, it is. There's no doubt about it, especially relative to gold. So you can make the argument both ways. One size doesn't fit all. If you look at like a bag of junk, $1,000 face value of silver, it's fairly bulky. It's 70 something pounds, and it's a pretty big unit. And, obviously you could store that in your house, apartment, bury it in the backyard, whatever you care to do. But what people don't realize is what the value at one time was. That $1,000 face value back when my dad was working for a living in his 20s, that represented about 3 or 4 months worth of labor. That's the value it had when we were on the pseudo silver standard before Johnson's slugs came out in 1965. So will it achieve that again? I think it will. But so there's your answer. I mean, I can defend it, but the facts are what they are. But for most people that really need it aren't going to buy it. It's for people that want it, and the people that want it will buy it. And then there'll be a big contingency, and Brian may or may not back me up on this, of the, oh my God, I missed it crowd.
Oh, yeah.
People that were believers and gave up because Morgan doesn't know what he's talking about. London's selling his own book. Fergus has just got a great accent. But these guys, they'll just push us off to the side. And once it takes off, they won't get back in because they can't admit they're wrong. And they'll watch it, and then they'll think back and have the I could have, should have, might have, if I just would have held my silver position.
Yeah, and from the other standpoint too, they're going to be people who jump in just because they're trend followers. The fear of missing out is incredible in precious metals in general, especially in silver. And you mentioned a bag of silver coins, $1,000 face value. That's my favorite way to invest in silver. And sure, it's bulkier than the same dollar value of gold, but that's really an advantage when you look at the fact that it's so much more divisible. You can have silver dimes, quarters, half dollars. So in extremis, when there is a real emergency, if there is a real emergency, and you have to actually use your precious metals in commerce, silver bags, old US silver coins are the most advantageous way to hold silver. And again, my favorite way. The key though is you have to buy this stuff when nobody else wants it, when premiums are low. Sometimes in history, in these cycles, a bag of silver actually has a negative premium or very low to it. Right now, you can't find them, and all silver coins have a very high premium. Some are lower than others, but relative to the historical norms, they're very high because number one, there's not that many out there. Demand is swamping the available supply. But the other thing is the actual cost to manufacture a silver coin, a new bullion coin, is a much greater percentage of the value of that coin for silver than it is for gold. The cost is about the same to make the coin, but for gold, it's almost negligible. For silver, it's a significant percentage of its value.
Okay, and maybe you want to leave us with your predictions, David, about, you said this end of the fiat currency or lack of confidence. I thought it would have already happened by now, right? We already see this elevated inflation in the United States, and yet I feel like we're not any closer.
Yeah, well, first of all, I thought it was happening in 1980. And to back up Brian a little bit about, fear of missing out. I mean, think about it. Back in January 1979, you're looking at $6 silver. It took 14 years to get there. It's an all-time high. Are you going to buy something at high? Well, yeah, if it's going higher. So those people that played the momentum game back then, and there weren't too many people understood momentum investing at that day and age. It went, again, an 800-fold increase in a very short time. I mean, you could get rich quick in the silver market in that one time frame. And I think we're coming up to that. Why hasn't it failed now? It's failing and has been ever since the 2008 financial crisis. It just hasn't manifested where everybody sees it. Now it's hard to not see it. With gasoline and diesel prices doing what they're doing, the food shortage, the problems with fertilizer and everything else is a reflection of the real economy. And as the real economy goes down, fiat fails. And as it fails, people look for alternatives. And the first alternative you should do is basically prepare your household for what you need. And if you have anything left over in savings, look at what your bank account looks like and ask yourself, is this going to be worth anything in the future or not? The answer is the dollar's not going to zero. There will be a reset of some type. There will be a new currency, a central bank digital currency, some type of mechanism that the bankers come up with to quote unquote save us and save the system, even though they're the root cause of all of it. Nonetheless, I don't see the dollar going to absolute zero, but you will lose purchasing power over time and it will accelerate. Yes, you'll see inflation subside and you'll see the rhetoric come out that we've whipped inflation now and all this horse pucky, but it's not the long-term trend. The long-term trend is a failure. All fiat fails and the dollar is no exception.
Okay, well, we'll wrap it up there. The website is themorganreport.com, and you can follow him at silverguru22 on Twitter. We'll have all these links on goldnewsletter.com/podcast. David, a pleasure to meet you. I hope we can have you back on.
Thank you.